Welcome to CoreLogic's monthly update on housing market conditions around Australia. This month we're focusing on how the housing market performed in August, which of course coincided with the second time interest rates were cut during 2016. The August rate cut was the 12th since November 2011. Since that time, the Australian cash rate has reduced by 325 basis points to reach 1.5%, which is the lowest on record. Importantly, for the housing market, mortgage rates haven't reduced by the same amount, with the average standard variable mortgage rate down 255 basis points over the same time, taking the typical standard variable mortgage rate to 5.25% and the discounted rate to 4.45%. Mortgage rates haven't been this low since 1960, which is likely to be one of the factors driving values higher. It's not just low interest rates that are pushing dwelling values higher though in Australia. If it were, we'd be seeing much more uniform growth rates across the capital cities and the regional areas of the country. In fact, the performance of the housing markets has been diverse across the country. Most capital city housing markets are only showing subtle growth trends, while Sydney and Melbourne have stood out based on their substantially higher rates of capital gains over the past two cycles. Other factors apart from low mortgage rates can explain the strong growth conditions that are evident in Sydney and Melbourne. Both cities have benefited from strong jobs growth, low unemployment and high migration rates from both overseas and interstate. Additionally, low advertised stock levels are likely adding to some buyer urgency in these cities. Listing numbers in Sydney and Melbourne have started to trend higher as they do each spring, but overall listing numbers remain well below the long-term average levels. While growth conditions remain strong in Sydney and Melbourne, the annual trend of growth has been tapering since the middle of last year. Sydney's housing market moved through a peak annual rate of growth in July last year at 18.4%. The annual pace of growth has since moderated back to 9.4% over the 12 months ending August. Similarly, growth in Melbourne has fallen from a 2015 peak of 14.2% to reach 9.1% over the past 12 months. Not all cities are seeing a decelerating growth trend though. The housing market in Canberra and Hobart have both gathered some pace over the past 12 months. A year ago, the annual trend rate of growth in Canberra was down almost 1% over the year. Over the past 12 months, the annual growth rate has picked up to be 7.6%. Similarly, in Hobart, the annual rate of capital gains has shifted from just 1.5% a year ago to reach 6.5% over the most recent 12-month period. A more subtle growth trend is evident in Brisbane and Adelaide, where dwelling values are up by 4.4% and 3.1% over the past 12 months, while values in Perth and Darwin continue to trend lower where demographic and economic conditions have weakened. Overall, the common thread across the Australian housing market is diversity. While the headline growth figures remain robust, it's very clear that capital gain conditions vary remarkably from region to region and across the types of housing. Transaction numbers are trending lower, which at face value may suggest some weakening of demand. Nationally, there are 15% fewer sales across the housing market over the past 12 months. While a reduction in housing demand is a likely explanation in weak markets, like Perth and Darwin, the same can't be said for Sydney and Melbourne, where values are still rising at a strong pace. These areas continue to show a low number of homes being advertised for sale, which is likely creating some level of urgency amongst buyers, which is supporting the upwards trend in prices. Total listing numbers in Sydney remain below 20,000, and the number of newly advertised properties added to the marketplace last month was about 21% lower than a year ago. As the spring selling season starts to ramp up, we would expect that listing numbers to also start their typical seasonal upswing. Whether this increased supply is absorbed by the marketplace will be important to monitor as the season progresses. Affordability barriers are likely to progressively add some natural resistance to housing demand if values do continue to rise. With wages growing at the lowest rate on record, it's hard to imagine this pace of dwelling value growth could continue much longer, at least in Sydney, where the dwelling price to income ratio is tracking at a record high of 8.4 times. Another likely break on the marketplace will be higher supply levels from newly constructed housing. Dwelling approvals data for July showed another surge in apartment approvals at a time when the number of high-rise apartments under construction is well and truly already at historic highs. In summary, Australia's housing market continues to demonstrate a strong level of resiliency in this record low interest rate environment, despite the many moving parts and somewhat divergent underlying trends. However, there are some headwinds that may prevent growth rates from re-accelerating, even if interest rates do move even lower later this year. As always, thanks for tuning into CoreLogic's Housing Market Update. We're always updating our housing market research at www.corelogic.com.au.